Imagine this. You check your phone on a random Tuesday and see that you just made money without doing anything that day. No posting, no selling, no clocking in, just because your money is finally working for you. Sounds like a dream. That's the magic of smart investing. And no, I'm not talking about day trading or pretending to be the Wolf of Wall Street. Hey, welcome back to GrowLeap Academy, where we keep it real about money, freedom, and designing a life on your own terms. This is episode 3 of our 4-part series on passive income. Today we're diving into investing, but in a way that actually makes sense, even if you've never touched a stock in your life. No charts, no jargon. Just the tools, strategies, and platforms you can use to start building long-term income, even with just a few bucks. Let's break it down. Step 1. Investing versus speculating. All right, let's clear up one of the biggest money misconceptions right at the start. A lot of people think investing is just guessing smarter. But speculating and investing are two very different things. Speculating is like betting on a coin toss in a cool app interface. You're trying to time the market, ride the next crypto wave, or jump on the latest stock TikTok is hyping up. This altcoin is gonna 100x by Friday. I'll flip this meme stock for quick gains. Sound familiar? It's fast, chaotic, addictive, and yeah, most people get burned. Not because they're stupid, but because short-term moves are unpredictable. Timing the market is like trying to predict next week's trending audio. You might get lucky once, but it's not a strategy. Investing, on the other hand, whole different vibe. It's calm, long-term, grown-up energy. You're not trying to flex, you're trying to build. And the key isn't hype, it's patience. Think of it like planting a money tree. You water it with small deposits. You don't dig it up every week to check if it's growing. You just let time do its thing. Real example. My friend Lena started out throwing cash at every crypto project that popped up on Discord. Her portfolio looked like a meme museum. She lost most of it during the 2022 crash. Now, she invests $25 a week into ETFs through Public. Doesn't check it daily. Doesn't freak out when it dips. She calls it her Future Freedom Fund. Because that's the goal. Not to gamble, but to grow. Speculating is adrenaline. Investing is peace of mind. And if you're serious about building passive income, it's not about chasing the hype. It's about creating systems that make you money while you live your life. Step 2. Basics of passive investing. All right, so now that we know we're not here to gamble, let's talk about how to actually invest in a way that's simple, low maintenance, and doesn't require you to turn into a Wall Street robot. The good news? You don't need to pick the perfect stock or read 400-page finance reports. There are 3 go-to tools that most smart investors, including the chill, future-focused kind, use to build long-term passive income. 1. ETFs, exchange-traded funds. Think of ETFs like a bundle deal for your money. Instead of buying one stock, like Apple, you buy a fund that holds hundreds of them. It's like getting a whole outfit instead of buying individual stocks. Example, VOO and SPY are 2 of the most popular ETFs that track the S&P 500, which includes companies like Apple, Amazon, and Google. When you invest in them, you're basically betting on the long-term growth of the economy itself, not just one company. Lena, 22, started putting $20 a month into VOO using the Public app. She calls it her anti-capitalist retirement plan, ironically funded by the top 500 capitalist giants. 2. Index funds. These are basically the low-key cousins of ETFs. They work the same way, tracking a whole index like the S&P 500 or NASDAQ, but they're usually bought directly through a brokerage like Fidelity or Vanguard. They're often cheaper in terms of fees, and they're designed to be totally hands-off. Ramit Sethi swears by them in I will teach you to be rich, and so do most millionaire next-door types. 3 dividend stocks. Now this one's fun, because you literally get paid just for holding certain stocks. Dividend-paying companies share a portion of their profits with shareholders, usually every quarter. That means you own the stock. They send you money, like a tiny paycheck from a company you never work for. Example: companies like Coca-Cola, Procter & Gamble, or Apple all pay regular dividends. One guy on Reddit called his dividend payments his boba fund. He uses the cash to buy milk tea every month. Passive income with a straw. Real talk. Tips for getting started. Download Public, Robinhood, or Fidelity. They all offer fractional shares, so you can invest with $5 or $10. No need to buy a full 500 ETF. You can get just a slice. Pick one ETF that tracks a big index like the S&P 500. Set up Auto Invest and forget about it. The market will go up and down, but over time, it historically goes up. Don't overthink it. The earlier you start, the more time compound growth has to work its magic. More on that in a sec. And hey, if you're wondering how to actually put this together into a mini portfolio, like, what if I want something super safe? What if I'm okay with more risk for bigger returns? What's the mix that makes sense for me? Stick around until the end of this episode. I'll walk you through 3 simple starter portfolios. Conservative balanced higher risk or higher return, so you can pick what fits you, even if you're starting with just $20. Step 3. Reinvesting and compound growth. Alright, this next part? It's honestly where the real magic happens. We're talking compound growth, aka money making more money on autopilot. You might have heard that quote, "Compound interest is the 8th wonder of the world." Yeah, Einstein supposedly said it. And whether he did or not, he wasn't wrong. Let me break it down in a way that actually hits. Let's say you invest $100 a month into an ETF that grows at around 8% per year. Pretty average long-term return, right? After 10 years, you wouldn't just have $12,000. Nope. You'd have around $18,000. And the extra $6,000? That's not from working harder. It's just from letting your money sit there and multiply. Now zoom out. Let's say you keep going. You invest that same $100 per month for 20 years. That's about the length of a Spotify premium subscription, if you started in high school. You'd end up with around $55,000 from just $24,000 invested. The rest is compound growth doing its quiet thing in the background. That's the magic of reinvesting. You don't just earn money from your money. You earn money from the money your money already earned. Real-world example? My friend Eli started putting $50 a month into a Dividend ETF when he got his first internship. Nothing fancy, just auto-invest plus auto-reinvest. 3 years later, his gains alone are worth more than what he put in that first year. And he literally forgot about it half the time. Hack for the lazy geniuses out there. Inside most apps, like Public, Robinhood, or Fidelity, there's a tiny setting called Auto Reinvest, or DRIP, Dividend Reinvestment Plan. Turn it on. It means whenever you earn dividends or small gains, they don't sit in your account doing nothing. They get automatically reinvested into buying more of what's already working. It's like saying, "Cool, thanks for the profit. Now go make more." You don't have to check it daily. You don't have to be glued to stock charts. You just need a plan and let time do its thing. Remember this: time in the market beats timing the market every single time. So if you're wondering when to start, the answer is probably yesterday. But the second best time is right after this episode ends. Bonus tip: how taxes reward long-term investors in the U.S. Let's talk about something that doesn't sound sexy, but can save you a ton of money. Taxes. If you're investing from the US, here's what you need to know. When you sell an investment, like ETFs, stocks, crypto, any profit you make is called a capital gain. But how much tax you pay depends on how long you held it. If you sell in under a year, it's a short-term capital gain, taxed like regular income, up to 37%. That's rough, but if you hold it longer than a year, it's a long-term capital gain, taxed at a much lower rate, 0%, 15%, or 20%, depending on your income. That's a massive win for patient investors. It's like the tax system is saying, hey, if you're not panic selling, we'll reward you. Example, let's say you invest $1,000 into an S&P 500 ETF. A year later, it's worth $1,200. If you sell after 12 plus months, your $200 gain is taxed at just 15% instead of 35% plus. That's real money saved. And by the way, many investing apps like Robinhood, Public, or Fidelity will show you how long you've held each asset, so you don't have to guess. Pro tip: mark your buy date somewhere. Even just a sticky note or calendar reminder that says, hold until date equals low tax, can help you stay the course and avoid selling too soon. Bottom line? The longer you hold, the more you get to keep. Not just because of compound growth, but because Uncle Sam takes a smaller cut. So yeah, reinvest your gains, zoom out from the day-to-day noise, and let time and the tax code work in your favor. This is how smart investing actually looks in real life. Step 4. Real estate without owning a house. Let's be real. Most people in their 20s or early 30s aren't buying property right now. Prices are high, interest rates are wild, and saving for a down payment? That can take years. But here's the good news. You don't need to buy an entire house to get into real estate investing. There are 2 accessible and beginner-friendly ways to get started. And both can generate passive income without becoming a landlord. 1. REITs, Real Estate Investment Trusts. These are companies that own or finance real estate, like apartments, office buildings, even shopping centers. When you buy a REIT, you're basically investing in a real estate portfolio, just like you'd buy a stock. And because REITs are legally required to pay out most of their profits, they often give consistent dividend income. Example, there's one called Realty Income, ticker O, that literally pays dividends monthly. People even nickname it the Monthly Dividend Company. You can buy it through apps like Public, M1 Finance, or Robinhood, even with just a few dollars. 2. Real estate crowdfunding. This one's more like teaming up with others to invest in property together. Platforms like Fundrise, Arrived Homes, or Realty Mogul let you invest in rental homes, commercial properties, or even full portfolios, sometimes starting with just $10 to $100. No mortgage, no tenants, no broken sinks. You just invest, and in return, you get a share of the income and appreciation. Quick story. My friend Josh put $50 into Fundrise just to test it out. A year later, he's up around $4. Not life-changing, but he literally forgot he invested. And that's kind of the point. Why this type of investing makes sense when you're just starting out. You don't need a big budget, it's hands-off and low stress. You get exposure to real estate, which historically grows over time. It helps you diversify beyond just stocks or crypto. Owning physical property might come later. But building a portfolio of real estate-backed assets? That's something you can do right now. Pro tip: some people combine REITs with dividend-paying ETFs to build a portfolio that sends them income every single month. It's like building your own paycheck, powered by smart investing. And hey, if you want practical examples of how to put this together, whether you're super cautious or open to more risk, stick around till the end of this episode. I'll walk you through 3 sample portfolios you can use or adapt for your own situation. Let's keep going. Right arrow. Step 5. Crypto and staking. But keep it chill, all right. Let's talk crypto. And don't worry, this isn't going to turn into a buy this altcoin now kind of pitch. We're keeping it real. Yes, crypto can be used for passive income. One way people do that is through something called staking. Basically, you lock your crypto, usually on a secure platform, and in return, you earn small rewards, kind of like interest. But here's the thing. Crypto is a roller coaster. It's exciting, sure. But it's also wildly unpredictable. Down one day, you're up 30%. The next, your portfolio looks like it fell off a cliff. Ask anyone who is staking Luna or Celsius. Ouch. So what's the play if you're curious but cautious? Here's a chill, realistic approach. Stick with the big names, like Ethereum or Solana. They're more stable, relatively speaking, and have legit staking options. Use platforms with a solid reputation, like Coinbase, Kraken, or Lido. Only invest what you can afford to lose. Seriously, treat it like your experimental money, not your savings. Don't FOMO into hype coins. If it sounds too good to be true, it usually is. Real example. My friend Eli tried staking ETH through Coinbase. He locked in about $200, got small rewards weekly, nothing huge, but it felt cool watching it grow. But when ETH dropped during the bear market, so did the value of everything. The rewards were fine, but the price swing wiped out the gains. Now, he's more diversified and sees crypto as a small slice of the bigger pie. Bottom line, think of crypto like dessert. Fun, flavorful, worth a taste. But not your main course. Build your foundation with ETFs, REITs, and dividend stocks. And then, if you want to experiment with crypto, do it with clarity, not emotion. And hey, if staking or blockchain stuff seems confusing, don't stress. You don't need crypto to build passive income. It's just one of many tools, not the tool. Ready for the next one? Let's go. Step 6. How to start small, even if you're brokish. All right, let's kill this myth once and for all. You do not need to be rich to start investing. You don't need $1,000. You don't even need $100. Honestly, you can get started with less than the cost of one oat milk latte. A ton of beginner-friendly apps let you start investing with just $1. Yeah, seriously, $1. Here are a few that make it super easy. Robinhood, slick interface, no minimums public. Great for learning with built-in education. Features fidelity, solid for long-term, fractional shares. Acorns. It literally invests your spare change automatically. Pro tip, set up something called recurring investments. It's like set it and forget it for your future. You can literally do $5 every Friday, $10 on payday, $25 a month, synced with your Spotify bill. It adds up fast when you stay consistent. Real example. One listener, Maya, told me she started by investing $10 a week into VOO. That's an ETF tracking the S&P 500. After a year, she didn't even feel the $10 leaving her account. But she had over $500 invested, and it had already grown. Not bad for a few iced coffees worth of cash. The key? Forget perfection. Focus on consistency. You don't have to time the market. You just have to spend less time thinking and more time doing. Start messy. Start small. Just start. Because the sooner you begin, the longer your money has to work for you. Want help choosing which ETF to start with? Based on your risk level or values. Tech, green, low volatility. Stick around. We'll cover that at the end of the episode with a few simple starter portfolios. Let's keep going. Step 7. Responsible investing. Put your money where your values are okay, real talk. Investing isn't just about clicking buy on some random stock or ETF and hoping it moons. If you want to build real wealth that feels good, you've got to go a bit deeper. It's not just about making money, it's about how you make it and what you support while doing it. So, let's break this down. 1. Diversify or die, financially speaking. Don't bet all your money on one thing, even if it's your favorite tech stock or a shiny new crypto. Spreading your money across different types of investments helps protect you when one sector tanks. Think, ETFs plus bonds plus a bit of cash cushion equals smarter, safer growth. 2. Zoom out. The long game wins. Short-term market dips? Normal. Crashes? Inevitable. Panic selling? Optional. When you invest with a 10 or 20-year horizon, you give your money the space it needs to grow. A wise quote from Morgan Housel, author of The Psychology of Money. The highest form of wealth is the ability to wake up and say, I can do whatever I want today. And guess what? Long-term investing buys you that freedom, not short-term hype. 3. Invest in what you believe in. You care about the planet? Animal rights? Tech for good? There's an ETF for that. No joke. Examples: ICLN, Clean Energy ESGV, ESG-focused companies, Environmental Social Governance, SHE, companies with female leadership ARKW, innovative tech, and next-gen internet. This is called value-aligned investing. And it's not just a buzzword anymore. More and more investors are realizing they can make a return and make a difference. Mini story. A listener named Eli DM'd me last month. He's 22, into ethical tech and sustainability. He built a tiny portfolio with just 3 ETFs, 1 green energy, 1 tech, 1 ESG. He said, "It's the first time I felt proud of where my money's going." That's the vibe we're going for. Quick tip. If you're using apps like Public, Fidelity, or E-Trade, you can literally type in your values or keywords, like climate or diversity, and find matching ETFs. Try it. It's actually kind of fun. Final thought. When you align your money with your mindset, you're not just investing in assets. You're investing in the future you want to live in. Let's keep going. We're almost there. Your challenge for this week. Track, don't stress, all right. Time to turn what you've just learned into action. But like the chill kind. Here's the mission. Pick one ETF that actually aligns s niczym, co ci dawa smysl. Into sustainability? Look at ICLN or ESGV, obsessed with tech? Check out VGT or ARKW. Want broad and stable? VOO or SCHD are solid picks. You're not buying anything yet. No pressure. You're just picking one, reading a bit about it, and adding it to your watch list. Bonus move? Set a weekly reminder in your Notes app or calendar. Check my ETF pick. Then just watch how it moves over time. Look at the little ups, downs, trends, and get used to the rhythm. Because this isn't about jumping in blind. It's about building the habit of observing, learning, and feeling confident around your money. Small steps now equals big results later. You've got this. Bonus: examples of beginner-friendly ETF portfolios. Looking to actually apply what you've learned today? Let's break it down with 3 simple beginner-friendly portfolio ideas. And yes, you'll find them all summarized in a free downloadable worksheet linked in the video description. 1. Conservative portfolio, slow and steady. Ideal for people who want minimal risk and stable growth over time. Goal: preserve value, beat inflation, and sleep well at night. 60%. VTI, total U.S. stock market. 20%. BND, U.S. total bond market. 20%. VXUS, international stocks. Simple, diversified, and designed to ride out the ups and downs with grace. 2. Balanced portfolio, growth plus stability. Ideal for anyone looking for a solid middle ground between growth and security. Goal, steady long-term gains with a bit of risk, 40%. VOO, S&P 500, 30%. VXUS, International, 20%. VNQ, US Real, Estate/REITs, 10% Arrow, BND Bonds, a great option if you're in your 20s or 30s and thinking long-term. 3. Growth-focused portfolio. Higher risk, higher reward, ideal for younger investors who are okay with some volatility. Goal, maximize growth potential over the next 10 to 20 years. 50%. QQQ, tech-heavy NASDAQ 100. 25%. VTI, total U.S. market. 15%. ARKK, innovation, disruptive tech. 10%. IEMG, emerging markets. This one's got more upside and more movement. Buckle up, but in a smart way. Want this on paper? Head to the video description and download the free worksheet with Portfolio Templates. Beginner-friendly tools. Step-by-step guide to start investing with as little as $5. Whether you're just getting started or fine-tuning your strategy, the key is to keep it simple, stay consistent, and think long-term. Wrapping up all right, we've officially demystified investing. No finance bros, no jargon, just real, doable steps. So let's recap what it really takes to build passive income through investing. A few bucks a week, one solid app on your phone, and a long-term vision for your future self. You don't need a six-figure salary. You don't need to be an expert. You just need to start. And yes, maybe it feels slow at first, but every dollar you invest today, that's your future freedom compounding in the background. Quick reminder, if you want all the ETF examples and portfolio breakdowns we talked about today, grab the free worksheet linked in the description. Everything's laid out for you in one clean place. Coming up next, in Episode 4, we're diving into how to scale your income using automation, personal branding, even faceless, and smart tools that work while you rest. We'll get into real examples, AI hacks, and strategies to level up your income without burning out. If this episode brought you value, tap that like button to help it reach more people. Subscribe to GrowLeap Academy so you don't miss what's next. We're just getting started. And hey, if you know someone who's been meaning to start investing for the last 2 years, send them this episode. It might be exactly what they need to finally take that first step. Remember, you don't need to be perfect. You just need to begin. Thanks for listening, and I'll see you in the next one.